Hi everyone, I'm Sierra, and I'm going to walk you through the financial story of AbbVie Inc. When AbbVie separated from Abbott Laboratories, it stepped into one of the most complex industries in the world at exactly the right time, where patents, R&D, acquisitions, approvals, and competition directly mold financial outcomes. For well over a decade, their biggest revenue generator was Humira, but 2024 is the year following US patent exhaustion in 2023, meaning this is the after of a very long monopoly era, now forced into a biosimilar competition landscape. So when we ask the real question, is the company financially healthy or not? You can't answer that by revenue alone. You answer it by liquidity, leverage risk, earnings per share, capital allocation strategy, and how efficiently shareholder equity gets converted into profit, which is exactly what I'll be connecting for you today. To help frame it even more clearly, I benchmarked 2024 ratios against consolidated filings from Merck & Co. because both companies coexist in the same regulatory environment, carry similar acquisition appetite, and fund pipelines very differently. All right, let's go back to the beginning. AbbVie was formed as a corporate spinoff from Abbott Labs, becoming its own publicly traded biopharma company in 2013. Historically, their identity was anchored by Humira, one of the best-selling biotech drugs in pharmaceutical history. At its peak, it represented the majority of AbbVie's revenue during earlier periods, making it the financial backbone that supported working capital, operating cash, and shareholders' returns for years. But when their US patent exclusivity ended in 2023, the company entered a strategic turning point. Instead of coasting, they redirected capital into new immunology drivers, oncology pipelines, and biotech acquisitions, funded largely through debt financing, which is a common model in pharmaceuticals, but one that carries higher liquidity pressure behind it. 2024 is the real stress test of that rebuild. So now we step into what the 2024 numbers reveal. AbbVie overlaps markets with Johnson & Johnson and Pfizer, but Merck gives us the best financial comparison snapshot right now. Why? Because numbers only matter if you compare them to someone else living in the same world. That benchmark helps to see what stronger liquidity looks like in the same environment and what leverage risk looks like when liquidity shrinks. AbbVie's 2024 current ratio comes out to 0.66, down from 0.87 in 2023, meaning they have 66 cents in current assets for every $1 of current liabilities they owe. That means their ability to cover short-term obligations exists, but with less cushion year over year. This signals tightening working capital and in pharma that often ties directly into aggressive development and acquisition spending instead of stockpiling liquidity. And you can see the same trend just magnified when we look at acid test. The acid test ratio is 0.43 for 2024 compared to 0.63 in 2023, meaning that only 43% of immediate obligations are covered by their most liquid assets when you remove inventory from the equation. That's a liquidity pressure point if sudden cash needs spike, but again, context is everything. This doesn't mean they are unstable, it means capital is being deployed instead of stored, which leads into leverage. The debt to equity ratio surged to 39.6 compared to 12 in 2023. This one matters big picture because equity shrank dramatically year to year, partly from share buybacks and landmark strategic investments, not collapsing earnings. And heavy debt financing is absolutely common in pharmaceuticals. It reveals a willingness to trade short-term equity share for long-term innovation pipeline expansion. But to say it clearly, higher debt strategy always carries higher risk, not bad risk, but calculated risk. Now, shareholder efficiency. Earnings per share dipped slightly from 2.73 to 2.40 in 2024. This is important because it highlights that even after patent exhaustion on Humira, AbbVie is still converting profit into shareholder per share value efficiently. It reflects steady core profitability, not operational instability. And the ROE, or return on equity, is 63% in 2024 from 35% in 2023. This looks really impressive, but keep this in perspective. It's partially amplified by a reduced equity base, not a massive earnings spike. This takeaway is still strong. Shareholders are seeing efficient equity to profit conversion, but leaders are backing most of that pipeline funding, not equity investors. The earnings-based interest coverage is 4.23 times in 2023, meaning AbbVie earns more than 4 times what they need to cover annual interest expenses. That's reassurance for lenders that interest obligations can be met. Cash flow-based interest coverage sits even higher at 8.7 times in 2024, which confirms that even as liquidity tightened on paper, AbbVie still generates strong operational cash. Operating cash declined from $22,839 to $18,806. Investing cash outflow rose to $20,820, reflecting biotech R&D driven acquisitions, which is exactly what foreshadowed leverage-heavy pipeline rebuilding for 2024 and beyond. This tells stakeholders the company is sacrificing short-term balance sheet comfort for long-term pipeline sustainability. So, in conclusion, AbbVie remains profitable, diversified, and aggressively investing into future pipeline strength post-exclusivity era of Humira. Their liquidity tightened year over year, their leverage increased substantially, equity shrank significantly, but EPS and interest coverage show continued earning stability. This is a healthy company built around long-term innovation and capital redirection, though short-term liquidity risk remains something both investors and lenders must acknowledge when evaluating capital strategy moving into biosimilar competition years. AbbVie is stable, just not cushiony, but biopharma rarely is. And that wraps it up. Thanks everyone, and good luck on your projects.